And now they're in a rush to stop quantitative tightening. Why? You happy? Are you happy with inflation rising at 3.5%? Now, I did go to school and did take a lot of math classes. So is 3.5% higher than 2%? It's a lot higher than 2%, right? So why are we looking for reasons to cut interest rates? And why are we looking for a way to get out of quantitative tightening when inflation is way above your target? And like I said before, prices need to fall, not go up more slowly from an unaffordable level. That's the truth.
Michael Pento, a noted financial analyst, forecasts a troubling phase of disinflation and possible deflation as economic activity grinds to a halt. Pento expressed significant concern over the U.S. dollar's health, drawing parallels with Japan's dire financial situation. He noted Japan's efforts to prop up its yen by potentially selling off gold and dollar reserves, highlighting Japan's stagnant GDP and long-term stock market slump. Pento also pointed out a global pivot towards tangible assets like gold and Bitcoin as nations seek to safeguard their reserves from potential sanctions and asset seizures. He criticized the Federal Reserve's approach, suggesting that their primary goal may be to maintain banking liquidity rather than controlling inflation or achieving full employment. This, he warns, could lead to a prolonged period of stagflation and financial instability, urging investors to reconsider their strategies in the face of these looming economic challenges. Hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Because I happen to think that Japan is dumping gold and dollars to prop up their currency. They're dumping treasuries, which are dollar denominated, dumping those, buying the yen on the FX exchange. I think they're dumping gold too. And for days like today, where I saw the yen was very weak overnight, and then you say, well, why is gold down today? Interest rates are down and the dollar's down. Shouldn't gold be up? But I think the bank. That's my theory. I can't prove it, but people say, what's the big deal if we become Japan? Japan's nice place, nice island nation. But when you think about it, Japan's a train wreck. The Bank of Japan is the market for JGBs, Japanese government bonds. Without that, there is no market. They don't trade. If the Federal Reserve came up and said, our goal is to be the banker's bank, and we care about keeping bank liquidity functioning smoothly, that's really our primary goal. And then by doing that, they have a tool. It's a fiat currency. It's not backed by anything. It's unfettered with the price of gold or tied to it in any way or any commodity. It's not tied to GDP growth. It's not tied to productivity growth. It's not tied to population or labor force growth. It's tied to one thing. What do these 12 apostles, the 12 voting members of the Federal Open Market Committee, what do they think? That's what it's tied to. And so what they say is their calculation is, banks will go under and we'll have a depression if we let asset prices fall to where they should be, where they can be supported by the free market. Can't have that. So we're going to pretend that we care about the poorest among you. But if they did, then wouldn't they just look at the Wall Street? This is not my numbers, the Wall Street Journal, and they undercounted it. A 37% increase in food prices. Nobody's income. Nobody. A very, very small percentage of the U.S. population has had their incomes increase 37% over the past few years. And as a matter of fact, if you look at the BLS data from the non-farm payroll report, a lot of people are losing we're creating part-time jobs and losing full-time jobs with benefits and higher wages. So there's a cogent argument to be made that, your incomes are flat. They're skewed to the wages and incomes are skewed to the higher end. The top quintile is doing fine. The lower four are getting wiped out. 78% of Americans are living paycheck to paycheck. I think some 60% of them don't have $1,000 in the bank. And that's that's a success. This never would be remotely possible if we didn't have 100% fiat currency. And the Fed didn't think they had a tool. I said, wait a second. Why do we have to live in reality? We could just print money. And every recession and every bear market can be monetized away with our tool. Isn't that wonderful? That's the truth. Then again, that's why I come on shows like yours, because you get the truth. The truth is that when you were able to untie your dollar, or whatever nation, Zimbabwe, Argentina, Hungary, Germany, whatever nation pursued that path, and they've done, various times throughout history, of just saying, hey, let's just print money to keep interest rates from rising and buy our debt. And that always gets out of control, and that always leads to hyperinflation. So you say, well, and some people say, well, that, Mr. Pento, that could never happen in the United States. Why not? Do the laws of economics not apply to the United States of America? Oh, because we're the world's reserve currency, but we're losing that. But Rome had the world's reserve currency, the Roman Empire, and that caused that still didn't prevent inflation from going to 1,000% per annum in Rome. It can happen. If it happened in Rome, the only world power there was in the known world, it could happen to the United States.
In today's market recap, silver is correcting back within an uptrend. Silver price is correcting back after rallying during May. The correction is likely to run out of steam eventually and the uptrend to resume. Support at $27.51 may provide the staging post for a bullish revival. Silver price is correcting back after the strong rally in May became overbought and bullish traders unwound their longs. Despite the correction, the short-term trend for silver remains bullish, and given the old adage that the trend is your friend, it is expected to.
So I believe since we have a huge problem now, let's just back up a second and allow me to elaborate for a second. So we were headed in this condition anyway, insolvency. And we were headed in that direction before COVID, but COVID exacerbated and expedited that condition. And now you see like 40% of the Russell 2000 is unprofitable. Corporate debt is $13.7 trillion. That's up 100% since 2007. Corporate defaults are soaring. They're up 80% since 2023. There's $1.3 trillion in credit card debt. Now, I want to just point out two other markets to you. So CLOs, collateralized loan obligations. So those are loans to businesses who really can't get money from a bank. That was $300 billion in 2008. It's $1.4 trillion today. That's a 366% increase. Then you have something called private credit. That's loans to businesses who can't get a loan from a bank or issue corporate debt. That was basically it wasn't even a market prior to the global financial crisis. It was $100 billion outstanding in private credit. Now it's up 1,600% to $1.7 trillion. And that's those two things. So you have three things, corporate debt, CLOs, and private credit are multiple trillions of dollars that are recycling that debt at higher and higher rates. They locked it in for a while, but now as every day passes, they're having to issue this debt at higher and higher rates. So I asked you to give me a little leeway here, so I'm going to tie it all together. So I believe that the Fed has to cut rates dramatically in the next quarter or two, significantly, trenchantly, to avoid the next recession. The problem is they can't do it. And the reason why they can't do it, they can tinker around the edges. They can lower rates by, 25, 50 basis points. But here's the issue. Here's the reason why they can't. Home prices are up 50% in the last 4 years. 50%. Taxes and insurance costs have skyrocketed. Dylan, home ownership is unaffordable. And then you take food prices, they're up 37% according to the Wall Street Journal, 37% in the last couple of years. So when you have a consumer and corporations that are under this much debt and this much uh, an onerous condition of refinancing the debt, what really needs to happen is for prices to fall. But what's happening is they're going up at a slower rate. So again, let me reiterate: if home prices are up 50%, and they are, according to Case-Shiller, in the last 4 years, I pulled that data up this morning, so it's fresh data. 50%, 47 change to be exact. Home prices need to fall, not go up more slowly. And when your trip to the grocery store costs almost 40% more than it did a few years ago, prices need to fall, not go up more slowly. But the Fed is out there saying, you know what, we have a victory. So they're not going up 9% anymore. They're going up 3.5% year over year change. That to the Fed is a victory. And why is the Fed interested in declaring that, obfuscating that as a victory? Because they understand if they don't get interest rates down quickly, we're going to have a recession, and it's going to be a sharp one. I don't think they can until the credit markets freeze and the money markets freeze. And in that case, we're going to have, and here's where I'll wrap it all up, I think we're going to have another bout of disinflation and perhaps even head into a truncated period of deflation as just everything just shuts down in the economy. That's a very salient risk. So how am I positioning my clients? I'm getting ready for possibly moving that in that direction, which would be sectors 2 and 1 of my investment spectrum. And then I see intractable stagflation after that, because the Fed's going to say, listen, we have to ignore the fact that home prices were up 50%. We can't let them drop even maybe 15, 20% without bankrupting every bank on the planet and every pension plan. And the consumer would, the wealth effect would go into reverse in a huge way if stock prices drop by 40%, which is where they need to drop just to bring them back into historical norms. So they can't let that happen. So then we're going to just go back to ZERP and QE and helicopter money. And if that happens, you're going to see intractable stagflation like we've never before seen. So a lot depends on what the government does. I think, and I even heard Janet Yellen today say that, listen, we have to get rates down. The Treasury cannot afford to refinance its debt. Don't forget the 10-year note was 33 basis points right after COVID. Now it's 4.6%. The two-year note's almost 5. It was 4.85%, 4.9. It was 5% a few days ago. But they just can, and they're issuing a lot of T-bills, right? A lot of this debt is being issued at the short end. Now, paying next to zero is great, but paying 5% when your debt to GDP is 123%, you have, was it $38 trillion of debt outstanding and rising rapidly?
What do you think of today's show? Do you agree with Michael Pento? Post in the comment section down below if you think America will enter into a stagflation period, and share your gold and silver price prediction by the end of 2024. Now watch this video right here because it's a perfect fit for you. I see you on the other side.